Welcome everyone. My name is Kimberly Chatfield and I'm the event specialist here at the Institute of Financial Operations. I want to thank you for joining us today for the webinar titled The Case of the Disappearing Credits. What a fast start to credit recoveries is best practice. This webinar is a free training opportunity for our Institute's members, and as always we're happy to have you here with us today. Your presenters today are Mary Schaeffer and Tom Flynn. We here at the Institute are happy to have both Mary and Tom here with us today to share their expertise in this area. So without further ado, I'm going to hand things over to Mary and Tom.
Thanks, Kim. It's great to be here, and it's great to be here to talk about such an interesting topic. Before we get started, I want to just go over very briefly what we're going to talk about today. We're here to talk about vendor credits. I'm going to start by giving a brief description of what we mean by vendor credits. That's kind of what I call about the background information. I realize that many of the people who are on the line know what this is about, but I want to make sure we're all on the same page. We're then going to move on and talk a little bit about what I call the communications issue. You may not, at this point, realize what communications has to do with vendor credits, but it has to do a lot with them. And hopefully when Tom gets on and he shares some of the data that he has, you'll get some tips on communicating with your vendors for matters other than credits, for other issues. We're then going to move on and look at some data. Now I know we'll be presenting a lot of numbers, and please don't feel you have to memorize the numbers. Please don't. In fact, don't. We just present the numbers so that they can paint a picture. We'll give you an idea of the magnitude of the issues, and you'll get an idea of what we're talking about. Then we've got some real-life case studies for you, and then, because I always like to talk about best practices, we'll have some best practices related to vendor credits. The first few best practices are what I call practices so you don't have the problem, so it will help you avoid the problem, or at least avoid the magnitude of the problem. And then the second set of best practices are what to do after you find you do have the problem. Before we close, Tom's going to talk a little bit about technology, and then we both have some concluding thoughts on this issue. So, Kim, here we go with our first polling question. And we want to understand where you stand and how you feel. So the question, simple, yes, no, or not sure. Do you have a problem with vendor credits? Yes, no, or not sure, hoping this webinar will help. And of course, Tom, that kind of throws down the gauntlet for us. And kind of interesting, we look at the results here. As you can see, 43% of you have said yes, you think you have a problem with vendor credits. A third of you think you don't. And 24% say you're not sure, you're hoping that this will help you decide. Okay, so let's dive right in and let's talk about the background, what I call the background information. What are we talking about? When we say vendor credits, what actually do we mean? We're talking about money that is left with a vendor or comes to be with a vendor after the customer, which would be you, pays an invoice. We're not talking about extending credit, which sometimes you'll hear the AR folks or the credit folks talk about vendor credit, and they mean something entirely different than what we do. We're just talking about money that's left with vendors, whether it's because of an overpayment on your part or funds that were generated through some other mechanism. And our goal today, by the way, is not only to get you to think about vendor credits, but to think about all the issues and focus on them and how not only you can recover as many vendor credits as you want, as you can, because obviously that's important, but also how you possibly can address some of the other problems that you may have that are creating vendor credits. So how do vendor credits arise? Where do they come from? Now obviously, let me start off by saying that we recognize that if you knew about the credits, you would take them, you would recover them. The problem is that you don't always know about them. In fact, frequently you don't know about them. So how is that possible? Well, for starters, you might have returns. Returns will always generate credits. Sometimes you have disputed invoices. Now, if you have disputed invoices that you're tracking and all of a sudden they go away, they're not an issue anymore, or a disputed item just on an invoice that you haven't paid, this should give you rise to think, maybe I do have a vendor credit problem, and you'll see why as we go on. Obviously, duplicate payments result in vendor credits, And they're kind of, when we talk about recovery, that's usually what we focus on, but it can be a lot more, as you'll see. We're also talking about overpayments, when you pay more than you should. Yes, it happens occasionally. Rebates, honest mistakes, and you probably can come up with a few more that I haven't even dreamed of. Vendor credits, big problem. They can be generated in numerous ways, and we need to be concerned about all of them. Now, the next thing that sometimes happens is people will say, but why don't the vendors give the money back? And the answer to that question, unfortunately, is no, not always. When you think of vendor credits, also think about duplicate payments. Perhaps 1 in 100 returns the funds. Most of them don't. They will issue, some of them will issue vendor credits. Unfortunately, as you probably are aware, when these vendor credits get issued, some processors actually pay them. Hopefully not often. But they only pay those credits when they get mailed or when you actually are aware of them. So sometimes vendors issue vendor credits, but then you're not aware of them. So that doesn't do you much good. And then finally, you know, the truth of the matter, the vast majority of the vendors don't want to give the money back. Or it's not a priority for them. They've got many more important things to do. So they're not going to focus on alerting you to their vendor credits and until you come looking for them. Many vendors, they put the credits on their books, and to be perfectly honest, the AR people have no interest in having these credits lying around. They want to clean them up. They want to get rid of them. They don't want them on their books. But many of them don't have the contact information, the correct contact information that they need in order to be able to get in touch with their customers so that they can get these credits off the books on a timely manner and on in a way that will clean up their books. So they've got these credits sitting on their books. They've got to do something within the AR people, and so sometimes they look for other mechanisms. So we have our next polling question. What percentages of the vendors do you think have open unresolved credits of your vendors? Okay? And perhaps we can put the polling question up, Kim?
We've got 20% that are 11 and above.
Okay.
We've got 29% is between 6.5 and 11. We've got 39% at 1.5 to 6. And 12% are up to 1%.
What's
no
interesting,
one is at 0.
Nobody is at 0. Okay, so everybody who's on this call recognizes that their vendors do have open credits. Now, if Tom were connected, he would be telling you that their research shows, and they've got a lot of numbers around this issue, is that the actual on average answer is about 6%. So somewhere in that 6 to 10% of all your vendors will have vendor credits.
The thing I would add about this is we do have quite a bit of benchmarking associated with this. And one thing that we find is when we communicate out with suppliers, there's 2 stats that I'd like to relay to everybody, and maybe in your own research you might see some similarities. When we communicate out with suppliers, we'll usually 1 out of every 11 suppliers that responds to our outreach will show some type of claim or open credit that's in their aging report. And about 1 out of 2, or I should say 6 out of 10, so in that 50 to 60% range of those credits are actually open credits and available for the client. So it's somewhere in that we see 1 out of 10 or 11 statements will potentially have a credit on it, and that about 1 out of 2 or 6 out of 10 of those potential credits will actually translate into a verified claim that is intended to be returned back to the client. And that's kind of how our benchmarking stats match up. And I look at the poll results from the group here on the webinar. I think that tracks almost exactly with what we would see as well.
I think it's interesting, Tom, that nobody thinks they have no unresolved open credits.
Most people realize that no matter how good your process is, because you talked about a couple of the instances that would generate credits, Mary, no matter how good your process is, we always see you can have great people and great process, but you're really at the whim of your data. And I think most people are realistic about the quality of the data in their enterprise. It can be very good, but there's no way your data can be 100% complete and that's going to create some sort of rough edge somewhere, and that will usually translate into transaction discrepancy or an open credit trying to find its way back to your company or to your AP group.
So people say, okay, so they generate these credits. What happens to them? Why do they go away? Why do you think they go away? So let's talk. Let's go down and let's look at a few of these things. And by the way, I'm not making these things up. These issues come from conversations with our readers. They write to me all the time, and it also comes from Tom's research. And also I kind of scroll around, if you will, in the credit world or the AR world, reading and talking to some of those folks. So it becomes, this is, anyway, it comes from real life. So the first thing is late fees. Now, everybody on this line is probably, well, most of you on this line are probably thinking, well, we have a policy, we don't pay late fees. And if we were in a live situation, I'd ask you to raise your hand, everybody who thinks they never pay late fees. And most of you would probably raise your hand. But the truth of the matter is what your vendors are doing, some of them, not all of them, is they're accruing those late fees, and when you get one of these open credits, and they're looking to clean up their AR, which they have to at some point, they're just using them to pay to write off the late fees, and you've paid them even though you don't realize it. The second issue, the second place that these credits go, is they go towards unearned early payment discounts. Now again, if we were in a live setting, I'd say to you, I'd ask you how many take the discount even if you pay after the discount period. And anywhere from a half to 90% of you would probably be raising your hand saying, yes, we take the discount, either regardless of when we pay it or if we just pay it a little bit late. And what many vendors do is they accrue these unearned early payment discounts, and when you come up with a credit, they just whoosh it away, okay? So if everybody here who's on the line who has a policy of taking the discount but paying on the due date, you possibly have this problem. Okay, then there's the old favorite of disputed invoices. You know, you think you shouldn't pay for something, the vendor wants you to pay for something, there's a quality issue, whatever, there's a disputed invoice. And all of a sudden, if your disputed invoices or your disputed items go away, don't think it's, the vendor finally sorted things our way. Possibly. Possibly they want your goodwill. But also possibly they've used your open credits to take care of the dispute and just taking care of it that way. Unauthorized deductions. Unauthorized deductions are something that make credit managers and AR managers crazy. But when you all of a sudden generate a credit and you don't know about it, they'll use it to offset the unauthorized deduction. And there's probably a whole bunch of other ambiguous fees. You know, the vendors will have handling fees or carrying fees for carrying this open credit that they never told you about. And you can probably come up with some other examples that I haven't included here that you've run into in your own day-to-day operations. And in fact, if you have, I'd love if you wrote me and told me about it.
Yeah, that would be interesting if we could share that. And you know, Mary, I also see this is very heavy in the human element. You know, obviously the work that Lavante does, we communicate with a lot of suppliers, and although a lot of companies model themselves after rules and standards and policies and procedures, when you find out that a credit is not properly returned or it's been used against something else, it's not because of some sort of policy or some sort of like nefarious conspiracy. It usually is a result of somebody saying, oh yeah, you know, I know that credit was on there in the last statement. We've since used that against an invoice 1, 2, 3, 4 because the invoice wasn't getting paid and the dollar amounts were about the same, and it was almost a wash. We actually gave you some credit because the credit was a little lower than the invoice. It's a very human, it happens very infrequently, but it accounts to large dollars. It's a very human reason. Sometimes you look for something more process-oriented, and also we'll see sometimes when something gets balanced forward. And you can see that if the number's out of sequence or if it looks like it's a different prefix. And you can just very reasonably talk to the supplier and say, hey, can you break all that out or unapply that credit to the invoice? Let's deal with the invoice separately and deal with this credit separately. But these are very human conversations, even though you'd like to think everybody's adhering to some sort of policy when they make these decisions.
And you even had the example, Tom, of a company that has a disputed amount of, let's say, I think you used $13, and a credit comes by for $10, and
Yeah.
the AR person looks at it and they say, oh, you know what, we'll just wash these, yeah, it's $3, no big deal, and, off you go and your credit disappears. Well, you didn't want to pay that $13 in the first place.
It's funny, like you use that example, and you think, really, are people making that decision and think they're doing me a favor when really they're costing me $10 or
Right.
whatever the math is. And it's funny, but it really does come down to that time after time again when there's so much pressure to resolve these open items that they make these spot decisions. And again, it's not in any adherence to a policy. It's just a spot decision that people will sometimes make when they're going through these countless accounts.
And Tom, just as on the AP side we have the communication issue, which we're now going to talk about, the vendors have the same issue on the AR side.
Oh yeah. In fact, one thing about data is it slices both ways. As difficult and convoluted as some vendor structures can be, the enterprises and the clients can get that difficult with many different divisions and departments and locations, and it cuts both ways. It's very difficult to understand who is my supplier, where do I communicate with, and the same thing for the supplier. Where is my client? How do I communicate with them?
And who should I be talking to?
Exactly.
And when you look at it, walking a mile in their shoes, putting your, trying to look at it from their perspective, everyone has too much work to do. Everybody's plate is overflowing. So, they have the $10 or $13 and they can get rid of it and they can get rid of it easily. It's just made their life a tiny bit easier. So why don't vendors return credits? Some of them don't want to. I've had credit managers say to me, oh, they probably owed it to us someplace else and we just haven't found it. Nobody likes to give back money, okay? And me too. I'm part of it. And then we've got the communication issue. Sometimes they just don't know who to talk to. And, on our side, many companies, and we're going to find out just how many, I think, in our next polling question, many companies, not only do they not update their master vendor file on a regular basis, even if they do that in an appropriate time frame, they don't update the contact information. And with that nice segue in there, let's ask you, when was the last time you updated the contact information in your master vendor file? Not sure cleansed your master vendor file to make sure that you don't have inactive vendors in there, or perhaps that you've used a coding standard to set the vendors up. But when did you actually try and update the contact information?
One observation that I have, just in very unscientific research, some of the stuff I have is very metric driven. Some of it's just you talk to 100 people over a year and you get a feel for it. I usually understand that most companies, and I wish we could ask this question so you guys can send emails to Mary or myself afterward. Most companies approach their master vendor file usually for a project, for some specific thing that they need to accomplish. It's not usually cleanup for cleanup's sake. It's usually if they need to collect TIN numbers through last year's craze, or if they have some sort of initiative to track diversity status. And that's when they'll send a large request vendor population-wide to try to discern this information or collect this information. To see just pure cleanup for cleanup's sake is something that I'm not accustomed to seeing too often, but again, it looks like this group is probably a little bit more ahead of the curve that way.
And I'm going to stick my neck out and say that perhaps they're a little bit ahead of the curve because we're asking this question now, not a year ago. And, this year, as Tom alluded to, we were all praised about we were going to have to issue 1099s to everybody. So there was this massive push to try and get good information in the master vendor file. And to be honest, I was a little surprised at the number of companies who had a communications problem. We're not here to talk about 1099s or W-9s, but let me just point out that all the tax experts that I talk to, without fail, across the board, every single one of them says that issue is coming back, probably piecemeal. So if you can start cleaning up the contact information in your master vendor file, might not be a bad time to get ahead of the curve.
We want to stay focused on, obviously we're going to get into some of Mary's research, but we're trying to cue this up with, obviously there's an issue with some credits that open up on vendor records. But then another element of that is having to communicate with those suppliers. we encounter it all the time. What is a vendor review? Is it just going out to your top 20% of vendors? Is it just sending a mail with one mail or two mails with no follow-up? Really, what constitutes the effort? So we will talk about a little bit of what Lavante's effort looks like, because I think we do a good job of a very marshaled and strategic approach to communicating with the vendor population. But before we go into that, let's talk about the challenge of communicating with supplier population. We have an image up here on the screen, and this is supposed to mirror all of our environments. On the right side of the image, you can see that vast array of these little manufacturing boxes, or these boxes with these smokestacks. These are meant to demonstrate your supplier population. So in your mind, you know that's 1,000 or 5,000, 10,000, 20, however many suppliers you have. And then on the left side of the diagram, that's your company. You have multiple locations and buildings. You have multiple files, multiple departments. And one point we were bringing up before is it's difficult in both directions. That bowl of spaghetti that we've placed in the middle, those lines going back and forth, that's meant to indicate, fill in the blank, documents going back and forth, transactions going back and forth, shipments, communications, phone calls, emails. It could be anything. And we've, as confusing as we intend for that to look, that's actually very simple. That should be 1,000 times more convoluted than it actually is. And to Mary's point, Mary was talking earlier about why aren't credits returned. And this is something that Mary and I disagree on a bit, where she would, well, quite a bit, where she'll say sometimes it could be obstinance or it's a decision. And I say, if you look at this, for one of those suppliers in that vast array to actually successfully get a credit memo back to the appropriate department at the client organization, because the client organization is going through the same series of mergers and purgers and acquisitions and staff change, for them to get the credit memo or the phone call successfully back, even though they intend to, is sometimes very challenging. And I would submit that all of this becomes a data issue. We're going to go into a lot more data, but the challenge of supplier information is that there's such a vast array on both sides, the company and the suppliers, and then the data is constantly shifting. And so at some point, though, you have to tackle this. Now, 44% of you did in the last year, where you wanted to reach out to that supplier population, but you're going to want to communicate out with your suppliers. So this actually segues into another question. It's kind of a similar wrinkle to what we were asking before, but and if we can demonstrate that. If you did reach out to your suppliers, what type of response outreach do you get? That's when you last intended to update your vendor contact information. What type of response are you seeing when you do head out with that aim to communicate with suppliers?
And that's just the first time, not when you went back and re-solicited.
Yeah, let's keep pure on the first request.
So I can see that the majority got somewhere between 21 and 50%, with 18% of you actually being successful in getting over 50% of the information. And unfortunately, 4% of you getting less than 20%. So how does this compare to what you see, Tom?
Very similar to the last poll.
Okay.
This group again is an advanced group.
And
what I'll do is let me roll out a couple of stats that kind of talk about two things: what we see in some of our research, some of it's unscientific, and then what we see in some of our benchmarking. Before I get into that, I want to address what we're not seeing whenever we run a poll like that. What we're not seeing is 100% compliance. Now, we're probably all sort of snorting a little bit that, like, we think we're going to reach out to 1,000 or 5,000 suppliers or 10,000, and you've completely given up on the thought that all of them would respond back. And that's what we were talking about a little bit before. I think we all take for granted that can't happen. And I wanted to point to two benchmarks that kind of speak to why that's really difficult to do. I'll start with the second one, where D&B was just last year put out some research that indicated that 2 out of 10, or 20% of companies. Now, these companies, of course, they're both clients, they're enterprises, they're suppliers, they're whatever it is. It's just a company, but 20% of them are changing some significant part of their HQ data on an annual basis. So that could be an address, it could be a parent company, it could be whatever it is. That would translate to a TIN number. It could be a main number, main line. But 20% are changing, which is really a lot of turnover. Now, I can also tell you in this top bullet, in our research, and this is very metrics-based, if you go down a level into the AR department, so if you're an AP department trying to communicate out with AR, we see 1 out of 2 suppliers is changing some significant part of their AR data on an annual basis. And whether that's the actual person, the manager of the group, the phone number, the parent company, something significant that would challenge your ability to effectively communicate with them. And that's why you see that nobody even presumes to approach 100%. Now, in contrast to some of the poll results we saw today, Mary, if you could advance the slide.
Sure.
In an unscientific review, we usually have conversations about, hey, what is it like when you reach out to your suppliers? What kind of response are you driving? Now, notwithstanding the fact that this group is doing a much better job, we usually hear across the board, I hear almost all the time, 15%. 15%. If I were to reach out to my suppliers, 15% would respond. I noticed a couple people answering the poll who kind of fall in that category. Other folks seem to be a little bit more advanced than that. But it just sort of speaks to the larger charter of this presentation today is talking about deriving bottom line and recovery from the supplier population. If you're only talking to 15% or 40%, it really challenges your ability to drive that type of, recapture that bit of cash flow. So one of the big considerations is, how effectively are you communicating with your suppliers? On the next slide, I'll talk a little bit about our benchmarking. Now, one thing you'll notice, I'm taking if we look at the left box, this is just some results that we've quantified. One thing you'll notice is I've broken up a first step into 2 steps. So it would be your first fax or email or your first postal mail. And if you combine those 2 steps, I think we typically see a little bit higher response than the industry standard, and that's because we benefit from the network that we have. We benefit from the fact that we're able to go out to suppliers and really augment the data that we get from our client supplier file with existing contact information that we have on all these suppliers in a network. And we're also able to see that in the drill down responses or the future responses, whether we're doing secondary postal mail or secondary fax, or when we get into a phone call campaign, we can really leverage the network of communicating with suppliers. So one thing that Mary's research is going to unveil is this is not something that the research she's done is not something that you can just achieve by doing one blast out to your supplier population. I think most people think we're crazy if you say you send out one request, you get this type of information, and you populate the results to this level. This is more of a concerted effort by leveraging a network, leveraging a technology. And then this goes into, once you establish this type of communication with your suppliers, once you're hearing from, we'd say up to six outreaches, now we're talking to 67% of your suppliers. So 2 out of 3 suppliers are sending information. That's just the first step. That's hard enough to do on its own, but what makes it even more difficult, or as Mary says, what's even worse, is you have to do several other steps beyond this. And Mary, you can kind of go into some of those details.
Okay, so what are we talking about here when it comes to credits? So your first step is you have to identify them. Now that's not always as easy as it seems, because a lot of times the vendor doesn't tell you, or they issue a credit memo, and even if they do issue the credit memo and perhaps send it along to your company, who do they send it to? It's not always clear, and it doesn't always get to the right person. We also have what I call the accounting system issue, and that is, I'm going to tell you a little story. I got a note from a woman one day, and she said, I was getting ready to tell you that I think you're making much ado about nothing. And the much ado about nothing was that I always advocate to readers that they get vendor statements, and they insist that the vendor statements show all activity, not just open invoices. She said, I was getting ready to tell you that I think you're making a big deal out of nothing, when I realized that our accounting system has the option to suppress credits. And many accounting systems not only have the ability to suppress the credits, that is the default that's set in their system. So you have to go in and reset it so to get it to show the credits. So actually finding the credits, identifying them is step 1. And then you have to recover them. Once you figure out what they are, you have to recover them, either in getting a payment made to you or applying it to a future invoice. Now,
I would also add, even more to the point, the most vital step that we take is you have to make sure that it's not already accounted for in either accounting system, either the supplier or the client. And that adds another element of difficulty when you consider that the supplier might have 3 or 4 or 5 different divisions, and the client may as well. So you have to find an effective way to make sure that that open credit is not offset somewhere else. And that's part of the recovery process. So what you certainly don't want to do is reestablish or reissue credits that people are already knowing about or already trading in, and that becomes a bit of an involved task. But unless you're doing that on a very automated basis, then this can add to a lot of confusion and double work as well.
Because you could end up taking the credit twice, and now you're in a really ugly situation.
No, the proper process, I believe, always has to account for that, because to just queue up a number of line items that we found or that had brackets around them or credit indication or negative minus sign in front of it, that does no good. You have to actually drill into the research and find out what is open, non-offset, and available for a deduction or a check collection.
Right. Okay. And now what we haven't talked about at all, and we're going to start talking about, is we're going to show you data that shows the longer you leave that credit outstanding, the more likely it is to disappear. So we want to start off by talking about some composite data that we put together. And this is on a few audits, a few of Lavante's audits that will be done in the beginning of 2009, so basically data from 2008 and prior, from 8 Fortune 500 companies. They gave me the access to this. We took a look at it, and I really do believe that picture's worth 1,000 words. So I want to go through this a little bit. Let's take a look at this. We're talking about the beginning of 2009, and we're looking at credits that were recovered. And you can see in 2008 there was a lot of money recovered. And then when you go 1 year backwards, almost half the money's gone. So did all these companies get worse all of a sudden? I don't think so. The credits, the organization, the vendors have found ways to use the credits, and we've already talked about them. So you can see, as I say, a picture's worth 1,000 words. In 1 year, well over half of the money is gone, maybe close to 2/3. And in 2 years, 3/4 of the money's gone. And after that, it's virtually all gone. So, I just, throw this up there to show you. It's not that all these companies certainly got bad in 2008.
2 points. Number one is I probably present this to most times when we're prospecting or at a lot of different panel discussions and whatnot. And one thing that comes up is a mitigating question like, well, were they previously working with another firm that would have found those dollars, or are they doing something internally? And the answer is, in some cases, yes, and in some cases, no. Some of the case studies that we point to, I can make very clear where they were using a firm that didn't find near the dollars we were finding. So even if they found some stuff from the prior year, they didn't account for all these claims that just magically disappeared by the actions of the supplier. And why this is at risk. And it's not a simple matter of an internal group or an external group getting to these credits before our methodologies do. This is really sort of a systemic problem of these credits being wiped off the map as you go back in years. And the other thing is, this graph, over time, over the next couple of years of the audit, different things will happen to it. But when you first start an audit, this graph always looks the same. It's always pretty near identical, where you have a big lump in this year, and you go back 1 year and 2 years, and you immediately lose all that opportunity because your credits are absolutely at risk. They disappear, and then there's no chance for you to recover them again.
They're gone. They're just gone. So now we're going to look at a few case studies. And the first one is a large retailer. We're going to look at these case studies. We're going to take a look at what was found. They're all anonymous. Nobody likes to talk about this stuff in public. Nobody likes to admit they do it, but it's a problem that we've all got. So we're going to start off with a retail chain, and we want to talk about auditable spend. I'm going to try not to say that word too often. So it's not the total spend of the organization, but just the spend that was given to the statement spend, so that the analysis could be done for the recoveries. Okay, so clearly you're not going to have things in there like payroll and rent and some other things. Or maybe you do have rent. I don't know. Do you do rent?
You know, in some cases, yeah, it can be problematic for a number of reasons. I'm sure a lot of people who deal with rent are nodding their heads right now.
Oh,
But
yeah.
you said it right. It's auditable spend. It has to do with you remove the red letter vendors or the sensitive vendors, and
Right.
or some people might want to start with a portion or a trial.
Right,
Whatever
and you'll
they
see
decide.
that.
Yeah, whatever they decide to review is what's auditable. Sometimes it's because they want to focus on one business division, and sometimes it's because remove a certain subset of vendors that are just too sensitive. So I've seen it in, there's no one way to approach auditable spend.
And when you're in business, you do what the customer wants.
Yeah, that's true.
Yeah, so, okay, so auditable spend, $6 billion, recovery $1.5 million, a little less than it, just under $1.5 million. Now, you want to go back. This was started in May of 2011, okay? Most of the recoveries were in 2011, and you can see almost double for what were in 2010. What happened? Did this organization suddenly get bad? No. So you can see if you want to estimate what the total loss would be per year for this organization, assuming that the processes stayed the same. And for the most cases, in most organizations, they don't get suddenly better or suddenly worse. You can see that they, if you look at the difference between the 2 years, between the 2008 and 2011, it's roughly $900,000 a year. Okay, money right out the door. And by the way, this money comes right off the bottom line. It's not like a sales figure where, you know, if you lose $1 million in sales, what comes off the bottom line may be $1 million, maybe $50,000 to $100,000. This is money right off the bottom line.
That's a good point.
So, and then if you want to look at it on a monthly basis, you can see just under $70,000. And if we believe, based on the past activity, if you stop doing this, or they hadn't done this, $2.5 million. Now, I kind of think it's interesting. 90% of the vendor details, the contact information changed within this period of time, and probably will on an ongoing basis. So that's part of the problem. Not all of it, part of it. You want to add anything to that, Tom?
No, I think there's that audit is 6 months in, so there's some stuff that we're still discovering about it. I think though, if you look at you said it very well. I think if you look at the chart though, again, there's that sharp slope, and then also things that people are going to be interested in. Did they have a previous auditor? They did. They broke out statements separately and were not near these numbers. I think that's something people are going to want to know. Didn't another firm find these dollar amounts? And they did find some dollar amounts, but it doesn't even come close to accounting for that delta. And then, you know, I look at this, and you look back 3 years, let alone looking back 10 years, all that opportunity that just vanished. You brought up the 90% change vendor contact details. That just happens to be, we have good retail footprint, so we're able to leverage our network very heavily to make sure that we're updating contact information. So it's not just a question of talking to suppliers and having them update their records. We can also get a running start by looking into our retail supplier network and you know, augmenting a lot of the file that way as well.
Okay. Now the next case we're going to look at is a technology company. Now the graph here is going to look a little different. I'm going to warn you that up front. And part of the reason for that is because there was an acquisition in the middle of this audit. So again, auditable spend, $1.4 billion, recoveries, $1.5 billion. This audit began in the middle of July, the middle of the year, 2010. What you can see, if you compare the numbers from this to the other, is there's a range of recoveries, some more, some less, but all the numbers, all the recoveries, significant amount of money. So let's look at this technology company. Again, the audit began towards the end of 2009, but interestingly, this graph shows that in 2010 there were more recoveries. So you're like, what's going on? Well, it turned out when you dug a little deeper that there was an acquisition in the midst of this, and the organization wanted that group to be audited as well. So you can see, again, on an ongoing basis, significant dollars, and again, 74% changed vendor contacts, and total recovery, $1.5 million. these are big numbers, okay? These are big numbers when they come off the bottom line. And Tom, I'm going to give you the opportunity in case you want to jump in a little bit on this one.
No, I think you pointed out, because we've poured over the results, I think you pointed out the nuance of how the chart looks a little bit different as it grows. I don't know if everyone caught the nuance of that, but again, that initial steep slope, because of the lost opportunity going back years, that still remains constant. And I can tell you that this firm did not have recovery audit in prior years. I think they go back to 2007, their last recovery audit, and it was significantly less. I'll just say it was significantly less than $100,000. So this was all greenfield recoveries. I mean, they didn't have anyone before us. And this is also an instance, this is really interesting, where they have very good processes. And we can tell that. We can actually see that by virtue of communicating with them, mapping their processes, talking to their suppliers. But they will be the first ones to admit that their data is a little bit of a challenge. They grew very quickly, and they grew by some acquisitions, and they mashed together a vendor file. So this is a question of the data leading to the recoveries and not the processes. Because I think a lot of people are going to be very, very rightly so thinking, my process is good. I've done due payment recovery.
Right.
I've done traditional recovery. There's nothing to find. But you do know that there might be an issue with your vendor file, and it could manifest in this type of recovery opportunity just because the data puts you at risk. And we can go into more detail on that, but no other point to add on this.
Okay, I just want to bring up one other point, which we haven't talked about here today. If you've heard me talk about duplicate payment audits at any time in the past, not only do I recommend them, but what I strongly recommend is that when they give you that management report at the end of your audit, that you take it, you read it, and you implement the changes that they suggest. And that's part of the reason why you'll see recoveries go down with the Lavante audit when people change their processes. When they identify the weaknesses, they see where the seepage is, and they change their processes so that doesn't happen anymore. So your benefit is not only that you get this money back, that's always a benefit, but you get a management report, which, by the way, you'd have to pay someone a lot of money to come in and do that consulting work for you. They'll show you where the money's, where you're losing the money, and hopefully you're smart enough to go and fix those those areas so that you don't have the continual loss. Okay, so now we're going to move on to the pharmaceutical company. This is obviously a big pharmaceutical company, an auditable spend of $10 billion. It's a lot of money. Okay, a recovery of $13 million for any organization, a big number to put right to the bottom line. Their audit began towards the end of 2009 in October, and there had been 2 additional audit firms in there. So imagine what the whole thing, all the recoveries were. So if ever there was a case to make for having a payment audit done, here it is. So what did they find? They found that this audit was started towards the end of 2009. You can see that most of the money that was recovered came from 2009. I'm sorry. Backtrack. I'm off on the wrong track. Okay. The audit was started at the end of 2009, but there were more recoveries in 2010. What's going on here? That's what I said. Well, another acquisition. There was an acquisition in the middle of this, and so apparently that company that was acquired, I'm guessing, Tom, I don't know this for a fact, had not had an audit done. So there was a lot of money to be recovered. But you can see here that here we have a recovery, an audit that was started at the end of 2009, and I'm pointing to my screen like you can see. I don't know what I'm doing. Okay, I think I'm in front of you live. Okay, so there was a lot of money, about $2 million recovered in 2009. What happened to the 2008 money and the 2007 money? Okay, so then there was an acquisition, more money in 2010, and a little less in 2011. Clearly these folks need to pay a little closer attention to the report that they're getting from Lavante, but a lot of money involved, and I'm sure they are. I'm sure that at the end of the day, when we go back maybe a year from now and look at this, the number will have dropped tremendously. And these people, again, only 58% of the vendor contacts had been changed, the details. But again, that's a lot of money. Anything, Tom, you want to add?
No, I think I believe we have one other case study besides this. Is that correct, Mary?
Yes.
I think the real point is that steep curve, and then rather than adding any points about this, I mean, obviously, I think there's a lot of food for thought. I have to credit Mary for bringing a lot of these elements to my attention. We knew about them, but I think she helped quantify it to a certain extent. If there's any questions about any of these charts, obviously I can add a little bit more color or details around what happened, what the environment was like, how did we start. But I think you did a really good job sort of drilling into this one. I think the next one tells a really, really interesting story, so I'll save any comments for that.
Now, this graph is going to be a little different, so I want you to pay attention. The audit began in March of 2008, okay? And as you might expect, given everything that I've told you so far, the majority of the recoveries were in 2008 and 2007. But hey, what's going on here? There were a lot of recoveries also in 2009, and then they dipped in 2010 and 2011. And again, this graph shows how when people go in and they get that management report, which I think is so important, whether you're doing by the way, a vendor statement recovery or a complete duplicate payment audit or a payment, whatever you're doing, get that management report and take advantage of it. Look at it and fix your processes. And that's exactly what this organization did. And you can see as we go down, as we go on in time, they're continually tightening their processes and recovering fewer credits. And let's face it, the best thing about credits is not to have them at all. So if you can get rid of them, more power to you. And that's kind of, if you want to call it the power of doing one of these audits, almost non-quantifiable, if you will. Result.
Well, to that end, I mean, preventing the loss is the exact same recoveries, but the time value of cash is through the roof, because you
right.
never spend it without with that money away from you being able to do stuff with it. And on this point, I said I was excited about this one. I have this silly name. I don't know if I mean, I think I watch too much late night infomercials. I call this the power curve of recovery. This sounds like something influenced from like a Chuck Norris like fitness infomercial or something. But
yeah, he added that to this slide, not me.
Right. so that's what you get. But what's interesting about this again is you start in 2008. Again, you see that steep slope. You lost a lot of opportunity a little in 2007 and a lot in 2006 and 2005. And that's we have to accept it, but it's unacceptable. What really gets me excited about this, sort of as a service provider, and I've been doing this. I mean, people have been doing stuff longer. I've been doing this 12 years. I get excited about this, and I see this curve with our clients that started in 2002 and 3 and 4 and 5. As you go back in time, we can get to this really elegant curve, this bell curve, where you not only start identifying those credits and returning them back to your client's bottom line, you can sort of quantify what was the lost opportunity in the past and what's leading to the credit, your exposure to credits. Is it a process issue? Is it a personnel issue? Is it a training issue? Is it a technology issue? And then to be able on this front side of the curve, or however you're looking at it, this right side of the curve, to start seeing the system improvements that prevent the prevalence of those ongoing credits is such an exciting experience for a service provider to add that type of additional value to the client. And also to be able to quantify it in terms of, if we fix your data, we can fix this issue. If we can explain to you the parent subsidiaries in your vendor file, or update contact information, or suggest an improved process, or get you in touch with a consultant like Mary to improve your process, and make those world-class changes, you can start seeing this, and then you can monitor it and make sure you stay at that low 2011 level or even lower. And that's really one of the most exciting things about this, is to solve that issue, because a lot of our clients, if they look at this long enough, they realize, I had leakage. This isn't something where I can go into my file, it's static. I can do a duplicate payment review of my 2007 payments. I can look at that this year. I can look at it next year. It's always going to be the same. If you don't jump on this right now, you may have lost the credit opportunity forever with no chance of resuscitating it. So to find that, to return it, and then to create a scenario or contribute to a scenario in an environment where it doesn't happen again is very professionally and personally satisfying. And I probably said too much about it, but that's one really great thing I see in this curve and other curves like it.
One of the disappointing things, at least to me, Tom, is when I talk to different auditors and they say, yeah, we give our clients a management report, we point out all the weaknesses, and they don't do anything, and we're back 2 years later collecting, covering the same money for them. That's, shame on the customer for that.
One thing I'll say about that is, we encounter that like any firm. And obviously, I have a lot of colleagues in the space at other firms that I think very highly of, and I think they do a great job with that. One thing I think differentiates this approach, and I think anybody would do it if they had access to this data, is the processes help, but what you're going to find is recoveries are not always a result of faulty processes. In fact, a lot of companies are doing some very, very inventive things. They're taking advantage of a lot of technology, a lot of the different plugins of their ERP system, a lot of different service providers, and they're doing things well, but they're at risk of their data, of their vendors changing something 50% of the time on an annual basis, and these credits sort of get away from them. The one thing that we do that helps create this power curve is to keep that data updated and maintained on an ongoing basis, on a steady basis. That's where you'll see less slippage. And even if they're not adhering to our management or our process improvements, we can still make a big impact by keeping that data fresh on an ongoing basis.
Just updating it.
Yeah, just keeping it updated and understanding where your vendors overlap. I mean, if you have 6 vendors actually doing business as one company and you don't have visibility into that, you're not only going to miss pricing discounts and terms, et cetera, but you're going to be a lot more ripe for duplicate payments in that environment. So to fix that and get that all under the one umbrella of one supplier, just for instance, that is huge savings to your bottom line, just for a simple move like that.
Yep. Okay, so now we're going to talk about best practices. Now, obviously, I think the best practice is to avoid the problem completely. You can't avoid it completely. It's like saying I never make a mistake or never, ever have to issue a rush check. You're going to have to, but we want to probably avoiding the problem. Probably a better term for this slide would be minimizing the problem. I can't tell you how strongly enough best practices rule when it comes to this. If you use best practices and you have good processes within your accounts payable function, you've won, I want to say, half the battle, part of the battle. You've taken the first step. Okay, you're never going to eliminate it completely, but whatever. Okay, so you want to avoid the problem. Use best practices, and one of the best practices, and I see this fall down all the time, is to identify disputed invoices early in the process, as early as possible, and then try and get those disputes resolved so that the invoice can be paid on the can be paid on the due date. If you can do that, I realize it's not as easy as I'm making it sound. You won't get that dreaded second invoice, and you avoid the possibility of getting a credit associated with this matter. Again, not as easy as I'm making it sound. I realize it. So you need to identify them, track them, and ideally the manager should be of the AP department or the supervisor, depending upon how you set up, should be tracking these disputed invoices and following up on them regularly with the processors or whoever it's supposed to be to make sure that they're resolved so that they don't ultimately lead to another credit, to a credit situation, or a disputed invoice, which then leads to a second invoice and a duplicate payment or whatever, okay? So good processes. Now, this is the one we alluded to at the beginning, that we had a polling question that we asked that we entered late. Here is the question, but we're not going to be able to answer it in the polling question. So if you can just type in A, B, C, D in the question box, we can kind of get an idea of where you're going with that. So on average, what percentage of disputed invoices are unresolved and not paid on the payment date in your organization? And obviously this is a guess. I mean, I suspect that very few of us know exactly. Maybe you do. So A, very few, less than 0.1%. B, just type in a 1 to 5. C, 5 to 10, 5 to 25%. And D, too many to count. And I'm looking over this. And one encouraging sign is we're seeing a lot of B's and C's. Oops. I was about to say we have no D's, but one just came through. Oh, and there's another one. Okay, and I see a few A's. So congratulations to you people with the A's, and this is the world we live in. Okay. Now, once you've got the credits, once the credits have been generated, okay, they're there. We've got to deal with them. We want to get vendor statements if you can, showing all activity. I kind of beat that horse to death, didn't I? And then, but once you've gotten the statements, you want to identify the credits and recover or use them. Keep good documentation, as Tom had talked about earlier. You want to make sure that the proper accounting is done. Okay, you can't keep a pad on the side of your desk. Otherwise, you'll end up creating a bigger problem than you already had. Next, you want to go and hire a third-party firm to find the credits and recover them for you. Now, you can do some of it yourself. I'm not going to say that you can't. But at the end of the day, and we haven't talked at all about this issue, if you want to review all your vendors and all the statements and all the credits, you probably don't have adequate staff, and technology will help you there. That's an issue we're not going to talk about today, but it is one that everybody has to deal with. And finally, I already got ahead of myself on this one, take that management report that they give you, study it, and make the changes where they indicate. Don't ignore the report, okay? That's just throwing good money after bad. And just remember, your third-party audits are not a one-shot fix. I mean, maybe, Tom, do you want to say something about communication and updating information here?
I think I think that is the key, communicating. There's a math equation here, which is if you're able to communicate with more suppliers and take more due diligence on each statement and be as exact as possible in the verification, then obviously that's going to get you mathematically the highest number of those dollars back to your bottom line, which you can put into all sorts of metrics and do stuff with. So I think in terms of the best practice, being able to communicate effectively with suppliers is paramount. And then in my personal belief, that's hindered by one thing, your inability to communicate with suppliers. It may be time, but the one big thing that stops you from doing that effectively is the data in your supplier population or your master vendor file. And those are things that if you have time to fix that, or if you are the head of the curve and fixing that on an annual basis, great. And if not, consider that that's going to stop you from being able to achieve a lot of your goals.
And remember, if you have some less than ideal practices, i.e., you're paying after the early payment date and you're taking the discount, if you're accruing late fees but just ignoring them, if you have disputed items that you let sit forever and ever, all these practices tend to lead to situations where you'll generate more credits.
That's true.
So
the data in your supplier population or your master vendor file, and those are things that if you have time to fix that, or if you are the head of the curve and fixing that on an annual basis, great. And if not, consider that that's going to stop you from being able to achieve a lot of your goals.
And remember, if you have some less than ideal practices, i.e., you're paying after the early payment date and you're taking the discount, if you're accruing late fees but just ignoring them, if you have disputed items that you let sit forever and ever, all these practices tend to lead to situations where you'll generate more credits.
That's true.
So, like I say, best practices rule minimizes the problem, or makes it takes away at least the top part. All right. So we've got our last polling question here for you. Do you think you have a problem with vendor credits? And let's see if we can.
Mary, this is clever. This is the first question we asked, right?
Yes, it was.
So we're seeing if we. I like your style. Okay, this is a nice little convention.
All right. So we convinced some of them. We still have 2% who are not sure. So I was hoping to get to everybody was sure whether they did or they didn't. Okay. So well over half of you think you have a problem with vendor credits, and hopefully we've given you a little bit of advice on how you can handle them. Obviously, it'll come as no surprise to you. Lavante does recovery audits, and they'd be happy to schedule a demo of their software for you to see. You can contact them. Tom, do you want to add anything to that?
A couple of bullets on here. I think this is kind of in line with some of our marketing message. I have to credit you, Mary, with some of the insights or some of our dialogue about the results that you saw got me even thinking about this a little bit differently. And if I had to break this whole concept down, this whole concept of recovery back to your bottom line or just doing these right things, I do look at it a little bit differently after this whole, what has it been, a 3-month process that we've been doing. I know we have a white paper associated with this as well, and some other research we've done. The thing I would add, separate and apart from anything you can read on your screen here, is I think the goal here is our ability to communicate with your suppliers. And one thing I think that kind of makes us a standout is we specialize in that communication, and I think I would net it down to 3 elements of that. I can keep that very brief. Number one is, I mean, there's a technology element, and we spent 10 years building a multiple patented product that, you know, we set some dials, and then this thing just works effortlessly, whether you're targeting 10,000 or 20,000 suppliers or any number. And there's a lot of, you know, a lot of security in knowing that, you know, we're using the right form of media, the right time of contact. If we knew a phone number worked last time, we're going to use it this time, or a fax or an email. You know, it really learns. The technology learns. We also can leverage that network I talked about. We have a network. I think the third bullet is a network of 2.1 million suppliers. I mean, obviously, in 10 years, we've filtered through a lot more than 2 million suppliers, but we've created a very crisp network of tight data that we can leverage to make sure we get a fast start. And that's great. I mean, you have technology, you have a network, but, you know, the biggest thing, and Mary, you'll identify this, and everybody will, is the people we choose. I think our chief asset is our people. I think their experience in the industry, their experience as clients, their experience as AR professionals. We have a couple really unique ways that we select our staff and we nurture them along the way. And it really creates an expertise in communicating with suppliers. And to get that part of it correct, really the rest of it falls into place. And that's something where I can make those high-level bullets. We're not doing a demo on this. I mean, if there's any questions about the mechanics of what we do or how do we do it, what does the application look like, if you want to look at some of the charts Mary came up with, I'm happy to show that. But I think from a high level, that's really what the magic is. If you can communicate effectively with suppliers, we don't presume that we would communicate any better than our clients. On a one-to-one communication, you would communicate with one supplier as well as we would communicate with one supplier. You probably communicate better. But we can have more quality conversations in a faster period of time. And if you can leverage and scale that process, you can do so much. You can collect information, not the least of which is credits or diversity stat, and anything along the way. That's what I would add about us. And I have to credit you, Mary, for bringing a lot of this to light to make me better understand what it is about our service that garners these results. So that's what I'll say about us for now. Probably a little too long-winded, but that's what you got.
That's very kind of you. I have some concluding thoughts. But let me just, you know, do my 30-second roundup, if you will. Vendor credits are an issue, I want to say, for most organizations. I say for everybody. I shouldn't be so dogmatic. But they are an issue out there. They will disappear if you don't claim them. It's an issue that we have to address. Technology can help. And I urge everybody to start their audits as soon as possible, looking at their potential credits out there, whether they do it themselves or hire a third-party audit group. Time is of the essence. It really is, because they do disappear.